I do think a rotation would be healthy should it occur. Generally speaking, when you get that kind of rotation, so in the prior times where we had that kind of rotation, in addition to being good for those select foreign equities, it also tends to be good for commodities, gold, and presumably Bitcoin. Bitcoin was not around in prior rotations, but presumably it'd be good for them because you generally have a weakening dollar, and kind of just capital more broadly dispersed and a little bit of a boom.
In a recent interview on the What Bitcoin Did podcast, Lyn Alden delves into the complex dynamics of the current U.S. markets, with a particular focus on inflation, Federal Reserve rate policies, and their broader economic impacts. At the time of the discussion, Bitcoin was trading around $54,000, having dropped nearly 3% in the past 24 hours and 16% over the past week, with more than 19 million Bitcoins in circulation. As Alden breaks down these issues, it becomes evident how these factors are shaping the financial landscape and guiding investment strategies.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
Yeah, I think basically it's more dangerous when you're in a very imbalanced condition. And so then the question becomes timing. There have been a lot of people calling for a rotation and a mean reversion of that trade. The last time there was a good window for it was 2019. That was the mid 2019. The Fed started cutting rates, so it was before COVID.
Yeah.
The U.S. economy was already softening. The Federal Reserve cut interest rates. By late 2019, because the repo rate spiked, they actually went back to balance sheet increases as well. And so, and you started to get this kind of mini, the dollar weakened a little bit. You started to get a little bit of a mini rotation into some foreign markets, but then COVID and lockdowns and everything. So that rotation never really materialized. A lot of countries were hit harder than that, especially developing ones, because of all the effects of that whole situation. And so this is probably the first window since 2019 where a serious possibility of rotation is at hand. And it's hard because you don't want to be, early. Like in my base case in 2019 was, okay, look, we're probably going to get a rotation. Then of course, the pandemic happens. You got to change all your outlooks. So there are certainly things that could derail that view. Like what exactly are we calling, the crisis here? I view this individual instance as less big of a deal than many market participants made it out to be, which is to say that this was a fairly mechanical shift. There was a deleveraging that happened. There's probably more deleveraging ahead, but less abrupt because now the pivot is in place. Now the trend change is more obvious. Kind of like the fear of God has been put back into anyone who was running a leveraged book. Like they're reminded, yes, there's risk. Yes, kind of like changes psychology in the market. And I think that I think Japan still has a big runway ahead, and all the different levers they can pull. Their stocks are not particularly expensive, right? So it's not like you're in the late '80s when they got their famous Japanese bubble. The valuations were silly back then. Whereas now the stock market is fairly reasonably valued compared to their cash flows and things like that. So it's not surprising that when there's a 12% drop, there's a number of people that say, "Wait a second, most that was almost entirely mechanical." So I'll go in and buy names that are inexpensive and oversold. There are unlevered entities could come in and take advantage of the fact that levered entities basically had to sell. Kind of like if you see a Bitcoin get a liquidation, if you're unlevered and you have some cash sitting around, some people come in and buy it. So we've seen some of a rebound in Bitcoin as well. And so I think that's normal. I think the bigger story is that aside from just the carry trade, the way that global finance works is that most currencies trade against each other based on interest rate differentials and current account flows. So if you're running a structural trade balance and your interest rate's not attractive, your currency is likely to weaken until you kind of find more of an equilibrium. The dollar has this extra monetary premium on top of it as the most liquid, most attractive currency in the world, the deepest capital markets. There's a lot of entities around the world that hold dollar-denominated assets. And so we get like a structural premium to our currency, which makes us really good at importing. We have tons of importing power, but it makes our exports less competitive. And so to meet that kind of global demand for dollars, we're kind of forced into running these structural trade deficits. and they accumulate over time. More and more dollars flows out into the world. They take those dollars and then they buy U.S. assets, and so everybody's kind of crammed into our stock market and our bond market and our private equity market and our real estate market. Everyone's kind of crammed in, but especially equities. Um, and so it's like a really kind of an engine that just keeps spinning. And there's a decent chance that can start to reverse in the years ahead. That as our economy slows down a little bit, as the weak exports weigh on our GDP, as there's rising political concerns around that trade deficit and the broader concept of reshoring and kind of actions we might take in terms of currency or in terms of trade to try to reduce that, you could get a partial, kind of flow out of that capital, which would be benefit some countries, but would harm others. And I think that we're probably on a setup like that. The last time we actually had a setup like that was after the dot-com bubble, when the U.S. cut interest rates. In the late 90s and early 2000s, the dollar was very strong. And there was the Asian financial crisis because they all had dollar dominated debts. A lot of them blew up. But when our economy softened and we cut interest rates, it kind of gave especially the developing world, more breathing room on their liabilities. And so from, say, 2003 to 2007, there was an emerging market boom. That's where we actually got the term BRICS from. Everyone was like, that was kind of the hot trade. That was like the Mag Seven, or like that was the main trade of the day, was these booming emerging markets. And maybe on a smaller scale, we could get something like that again, which is if the U.S. finally runs into some economic headwinds, trims interest rates. Some of this capital that is just so on one side of the boat, so stuffed into U.S. markets, could start to come out and go to certain pockets of the globe where things are cheaper, where their dollar denominated debts are now like under control, and you can start like a virtuous flywheel into those types of areas.
Lyn Alden passionately discusses the impact of inflation and the Federal Reserve's rate decisions on the markets. She delves into the reasons behind the recent rate hikes by the Fed and their effects on both the domestic economy and global markets. This conversation underscores the challenges investors face in navigating this volatile environment and the crucial role of strategic asset allocation. Now, let's listen to Lyn Alden's insights on potential future market movements and how investors can best position themselves in response.
It can be bad for American consumers, right? The ones that have kind of been on the winning side of a lot of things. You can kind of get more inflation in the U.S. You can get more higher energy prices in the U.S. It's kind of like a band-aid being taken off because it does increase our export competitiveness to some degree. Um, so there are kind of winners and losers from that. But basically, if you're a foreign exporter, it might not be amazing. And if you're an American consumer, it might not be amazing. But it's kind of so imbalanced right now in favor of foreign exporters, and in favor of American consumers. And it kind of reaches like a breaking point eventually. And those groups generally will not love that type of period. Whereas anyone who's a consumer in all these places with weaker currency, they generally do better. And American exporters could maybe not do amazing because we've got structural issues there, but they could get breathing room. For example, all else being equal, it's some tailwinds in their favor. I mean, it wouldn't be that significant considering that they're over 5%, so it's less than a 10% reduction in interest rates. So it wouldn't be that unusual, but it would be interesting to go from 0 to 50 basis points that quickly. And so the signs generally are, the US, because we're running very strong, like very loose fiscal policy and really tight monetary policy, we've had kind of like two different types of economies in the US. If you're on the right side of deficits, you've been doing pretty well. Meaning, for example, if you're catering to upper middle class travelers, the travel industry's been doing great. Whereas the commercial real estate market's obviously been terrible, and the manufacturing sector has been in basically a mild recession for like a year and a half. Um, and the labor markets have been fairly strong. The consumer, especially the upper half of consumers, has been fairly strong. But what we saw in the last week was manufacturing weakened more than most economists thought, and um, payrolls, like jobs, weakened more than most of them thought. And so, we started to get that probably contributed to some extent to the yen carry trade unwinding as well, because in addition to Japan trying to tighten their own currency, we also got weakness in U.S. markets, more rate cuts priced in, and therefore that contributed to a weaker dollar there as well. So you have kind of a 1-2 punch. In addition, partially because of this, carry trade unwind, we got a uptick in credit spreads, which is basically saying that the interest rate gap between junk credit and, like, say, treasuries widened. It's still fairly low, but it's now moving in an upward direction, which is generally signs of basically financing stress in some of the more sensitive parts of the economy. So there's a number of things that are kind of pointing to at least gradual economic deterioration in the U.S., which generally leads to interest rate cuts and just kind of more accommodated policy, which, it might not even be that helpful for a lot of U.S. businesses, but then ironically it could, as I mentioned before, boost some of those emerging markets that have dollar-denominated debts. The nickel was this catalyst for accumulated frustrations that people had, and that's, I think, what we're seeing now in some developed countries. We're seeing it in the United States, we're seeing it in the UK, we're seeing it in parts of continental Europe, and basically, there was this chart I saw. It was Michael Green that shared it. Basically, it's like it was America, but it was like real disposable income after, like, shelter, food, transportation, and all this. And it shows that ever since about the past 10 years or so, it's been going kind of sideways to down, which means that most people's everyday experience and it's like the median person. So most people's everyday experience of affordability and quality of life has not as it went from structurally improving to not really doing great. In addition, in the United States, it's kind of the first period of time where life expectancy is actually going down to some
Weird.
extent, which is a really bad sign. UK is in a similar position to the US, where you have trade deficits. So you've had a little bit of hollowing out of your industrial base, which you've kind of observed that as well. It's just kind of like industrial towns on harder time, working class. So it's a similar position as the United States. And so people increasingly sense that something's wrong. They're not really sure what it is. Like, they're not really sure what mechanisms are there. And then you get more distrust in institutions. So both the US and the UK and elsewhere, people that say, I think government's doing a good job, or I think the media is doing fair reporting, or I trust medical authorities, or I trust, whatever the case may be. Across the board, that trust is generally declining to fairly very low levels. More polarization, more frustration build up, economic frustration, and then you have, like, very real policies that do, people do have, say, rightly criticism of, like, how, immigration's good, but if you immigrate a ton of people all at once and there's a lack of assimilation, people can, I think, rightfully get concerned about that to some extent, and of course it can be taken out in harmful ways. But then people start debating, well, what's going on socially while all these other economic things are happening, and then people can unfortunately take it out in violence and hate when it's some of these problems are very hard to solve. And I tie a lot of it back to broken money, not everything.
Yeah.
But if you kind of catalog over time, over decades, as a species, we consume more energy per capita, so that's good. Our technology is way better than it was years ago. Some of it's actually got harmful effects, but either way, we at least have better technology than we once did. But our money's, like, worse than it was a while ago, especially if you're outside of these major countries. But in general, money's bad. It's like that one area where technology's not really made it better. And it causes all these imbalances and all these one part of the economy gets hollowed out, and this other thing has, like, this unfair advantage, and then it kind of rotates, and people, these big forces happen around them, and they don't really know how to frame it, how to contextualize it. It's much harder to have debates over fiscal policy than it is to have over social war stuff. So when the fiscal policy, or just the overall economic situation, when that gets messier, fewer people are able to articulate it. And so they articulate it in more visible ways, more social ways. That's where a lot of that anger gets expressed a lot of the time.
In this engaging discussion, Lyn offers valuable insights into how current monetary policies are transforming the investment landscape, and what this could mean for the future of the U.S. economy. We leave you with two thought-provoking questions. How will ongoing inflationary pressures shape the Federal Reserve's future rate decisions? And what strategies should investors consider to mitigate risks in this uncertain economic climate? For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.